Hello everybody. So if you want to see how my formula for investing works and beats the overall broad market like the S&P 500 and Dow Jones, go to the website Investopedia. It's a financial website and you can run a virtual portfolio like it's real money. You can buy and sell stocks, and so if you type in my name, Mario Lorenz, there, you have to first start your own account. It's free, but you type in my full name and you will find my portfolio there, and you can follow me there, and then you can see how my method of investing beats the markets, and it always will beat the market. That's because I'm a contrarian investor and I'm buying stocks that others are selling, and then when the companies turn things around, then you can reap the rewards. Most people will sell when there's bad news, so they will be selling a stock as the price is dropping, and then they won't rebuy into the company until good news comes around and the stock starts climbing back. Then they buy. Well, it's too late then. You have to have already bought and own it so you can reap the rewards when it does come back. Because here's the reason why most active money managers cannot beat the benchmarks, and that's because they think they know everything. They think they can predict the markets, and they can't, because there's so much irrational investing out there. Investors are buying stocks when they're overpriced, they're selling them when they're underpriced. That's why you be a contrarian investor and you start buying stocks as the company has a problem and the stock's dropping. That's when you're buying, and you keep buying it, blocks of shares until it bottoms out. And there will be a bottom if you're doing this with a good strong company, with good cash flow, with their current assets are much higher than their current liabilities. But really good strong blue chip companies, you buy them when they're taking a beating. And when you buy shares into a company, you don't buy your whole stake into that company at one price. You just buy a small block of shares, and as it continues to drop, assuming if it does continue to drop, you can keep buying shares. If it doesn't drop, then fine, you're going to make money on the upside. But you've got to have always a pool of cash on the side so you can take advantage of any situations. Most active money managers don't get this, and they will pretty much spend the majority of the money and have it all invested in stocks. So when bad times, something happens and things are dropping, they cannot take advantage of that. The only thing they can do is watch their investments drop. But you got to have a pool of cash so you can make purchases as it's dropping. And stocks, they will always have a bottom unless the company goes out of business. As long as the company, you're buying into companies that are not going to go out of business, you're going to make money as long as you follow to the bottom. The bottom is where there are no more sellers selling, and therefore it's not going to stay at the bottom. It'll eventually rebound because the sellers are already out of the market, out of it, and things will eventually turn around, and then people will start buying again, and you don't have to buy because you're already bought. So this method of investing is basically about as close as you can get to being able to predict the market. Like if you got the business section of the newspaper a day in advance and could see all the stock prices. But again, most active money managers don't get this because they think they can predict, and they think they're almighty and knowledgeable. So please follow me on Investopedia and you will see how I will always beat the market. Thank you very much.